Today I'm going to rank 16 different investments available to private investors from best to worst. So you decided to start investing. Congratulations. This means that you have now begun to take your finances to your own hands and think about ways how you can let your capital work for you. However, with countless investment options available to you, from traditional assets like stocks, real estate and bonds, to newer asset classes like cryptocurrencies or NFTs, the quest for the ideal asset class can be both thrilling but also overwhelming. So let me help you by ranking options from please don't touch to this is certainly a good choice. And you most certainly don't want to miss the last part of this video, because I think there will be a few big surprises. And so without further ado, let's get started. Okay, hey there, my name is René Salman and I'm just going to jump right into it. So here in this tier list maker, you can see all of the investments that we are going to rank today in this video. And of course, I would also love to know what you think. So whenever you disagree with one of my rankings, feel free to share your opinion, your thoughts in the comments down below. Okay, and maybe just very briefly, I'm sure many of you will have heard the term asset class before, but let's very quickly define the term. An asset class is basically a group of investments that look and behave similarly. They are subject to the same laws and regulations, and they share common characteristics such as risk and return profiles, liquidity, tax rules, or other relevant parameters. And with that out of the way, let's look at the first asset class. I'm going to start with cash, an asset class that we are all very familiar with. So I think cash is actually a bit of a tricky asset class because the value of this asset depends on your time horizon. In the short term, cash actually does provide some value. It allows you to buy other assets when they are available at very cheap prices. Let's say we are experiencing a major economic shock, like when the pandemic started in 2020 or the financial crisis of 2008. And during such major crises that may occur once or twice a decade, some assets, or quite a lot of assets, become incredibly cheap, providing investors with excellent opportunities to start an investment here that provides very satisfying future expected returns. And you can only make use of these once in a decade opportunities if you have the required dry powder, which is cash. So cash definitely provides some option value in the short term. However, cash is actually a terrible investment. By many, it is perceived as one of the least risky investments because it doesn't move around in value as much as maybe other assets, and it's also highly accessible, very liquid, but over the long term, it's one of the worst investments you could make. Your money will definitely be losing value almost every single year once you factor in inflation. So that's why I'm going to put cash into the C tier here. Okay, next, let's take a look at crypto. Cryptocurrencies can certainly be considered newer asset classes. And while the majority of people probably think of Bitcoin when they hear the term cryptocurrency, there are thousands of different cryptocurrencies, both large and small, that you can choose from. However, cryptocurrencies are so-called non-productive assets. And as the name suggests, these assets don't produce anything and they never will. Okay, I want you to pay special attention here. The value of any asset is the present value of all future cash produced by the asset, discounted back to present value by a specific discount rate. And intelligent investors now try to buy these assets for less than the value of all future cash flows, or at least at a price that yields a decent return. This in turn means that if you buy a non-productive asset, like a crypto token, you can only hope that someone else buys them in the future at a higher price, because the asset itself doesn't have any intrinsic value. Just owning the crypto doesn't provide any value besides maybe a sentimental value. So without a doubt, crypto goes into the D tier. And just to be clear, I'm not saying you can't make any money with crypto tokens, but you cannot invest in them. You are speculating, which is okay, but you have to be aware of it and call it as such. And this brings us to NFTs. An NFT, short for non-fungible token, is a digital asset that represents ownership or proof of authenticity for a specific item, like for example a piece of digital art. Now luckily, we've just discussed the idea of non-productive assets. And obviously NFTs are non-productive in nature too. I'm sure many will have heard of the concept of NFTs because there was a lot of hype surrounding this asset class, especially in 2020 and 2021. But when the hype was gone, we can see what can happen to the prices of non-productive assets. that, as I said, are speculative assets. One of the most extreme examples that I recently heard of is that the NFT purchased by Logan Paul for around $620,000 in August of 2021 has now lost over 99.9% of its value. And similarly, there's the story of the NFT of the very first tweet ever posted by Dorsey, so the founder of Twitter, which was sold for $2.9 million to some crypto entrepreneur in 2021. But reportedly, this NFT now is worth less than $4. Now here's the good news. If you are an educated and intelligent investor, such a loss could never happen to you, as long as you stick to your principles and beliefs, because as an intelligent investor, you are only investing in productive assets when you can buy them below their actual intrinsic value. So of course, we have to put NFTs in the D tier too. Now here's the first interesting asset class that you can seriously consider. And that's maybe also a little controversial. Real estate. Real estate refers to the physical space that is either used as a primary place of residence for doing business or to generate income by letting others make use of the property in exchange for rent or lease payments. And clearly, real estate offers some unique advantages. It first and foremost produces real cash flow, unlike crypto and NFTs and cash, at least if you're not going to use the property yourself. And as such, the property does possess intrinsic value, as we have explained previously. You can basically take the income generated by the asset in the form of rental income, then subtract all the expenses related to the property, such as maintenance or mortgage payments, and then compare the income to the purchase price. On top of that, you can also generate a return from any capital appreciation by the property and the land it sits on. So clearly, real estate is going to be ranked higher than all of the other asset classes discussed previously. However, I'm not going to put it into the S tier. I think this might surprise some of you, but that's because real estate actually has some drawbacks too. I think I could do an entire video series on the different drawbacks of real estate investing, but let me just quickly highlight a few of the disadvantages. First of all, the house itself is a depreciating asset and only the land it sits on is usually appreciating in value. Then you have to be aware that unlike the common conception, property prices do not always go up and the development of property values depends entirely on the market. Robert Schiller has actually shown that once you factor in all of the property related expenses, the inflation adjusted return of real estate is barely beating inflation. So what you need to do to boost your returns is to add leverage. But leverage of course comes with its very own risks. And then finally, real estate is also a rather time-consuming asset class. You need to manage your tenant relationships, you need to take care of maintenance, repairs, and so on and so forth. Yeah, and maybe I should also point out the lack of diversification that often comes with owning a property that is worth multiple hundreds of thousands of dollars. So that's why I will put real estate, the asset class, into the A tier. Next up, we've got bonds. Essentially, bonds represent loans given to governments or companies. Now, where we put bonds in our tier list really depends on your financial goals and where you are at right now on your wealth building journey. Are you in the wealth accumulation phase, or are you already wealthy and now are mainly trying to preserve your wealth? I think bonds are an excellent asset class for wealth preservation, but not for wealth accumulation. Now, I'm going to put bonds into the B tier, and here's why. Bonds are a productive asset. They generate cash. You actually receive money for the loan that you provide. That's basically your return. It's called the bond coupon or the bond yield. And I think the big advantage of bonds is that most bonds, like for example, the 10-year US Treasury, can be considered extremely low risk. In fact, the return of US long-term bonds is often referred to as the so-called risk-free rate. However, the returns of bonds are usually also much lower compared to other asset classes that we will discuss in this video. You simply receive a small but very predictable return over time. As I said, that's called the bond yield. However, as I said, if your goal is to build significant wealth, personally, I believe that most interest yielding instruments like bonds and loans are not the way to go. And that's why I put bonds in the B tier. Okay, if you're waiting for me to discuss stocks as an asset class, we are almost there. And I will also look at different types of stocks. But first, let's discuss another asset class, gold, which I often refer to as the overrated asset class. So So why do I think gold is overrated? First of all, there is a common misconception. People believe that gold is a great hedge and not very volatile, that it reduces the volatility of your overall portfolio. But that's simply not true. Historically, gold has been a rather volatile asset class, more volatile than stocks, while at the same time delivering much lower returns. In fact, gold has delivered pretty bad returns if you take a long-term view. If you bought gold in 1980, for example, adjusted for inflation, you're still not break even. And guess what? That's because gold, just like crypto or NFTs, is a non-productive asset class, which makes it a speculative asset class. You cannot invest in gold. Obviously, there will be multi-year periods during which gold performs very well. That's just the nature of speculative asset classes. But as we have just shown, over the very long term, gold performs pretty terribly. I think the only thing that distinguishes gold from other assets like Bitcoin is that gold has been regarded as a safe haven, a stable store of value by human beings for more than a century. And that's why I've actually put it in the C tier here. Okay, another asset class is referred to as collectibles and would include things such as rare books, expensive watches, rare wine, art, classic cars, or even trading cards. I think this asset class has a couple of disadvantages. One disadvantage is that investments in these assets require a lot of expertise, and when you actually want to buy or sell them, you usually encounter significant transaction costs. And of course, most collectibles are also very illiquid assets. So due to their, again, non-productive nature, collectibles go into the C tier. Then we got REITs, which brings us back to the area of real estate. REITs are real estate investment trusts, and essentially they are investment vehicles that allow individuals to invest in real estate assets without directly owning, managing, or financing properties themselves. So that's great, right? REITs pool capital from multiple investors to purchase, operate, and manage income-generating real estate properties. And I think this eliminates some of the previously mentioned disadvantages of the real estate asset class. First and foremost, the lack of diversification, the lack of liquidity, and the time commitment that comes with it. Here's one disadvantage of REITs, however. By law and IRS regulations, REITs must pay out 90% or more of their taxable profits to shareholders, basically in the form of a dividend. And REIT investors who receive these dividends are taxed as if they were receiving ordinary income. So again, we have to consider your goals. If you want to just preserve your wealth and receive a steady source of income, that's great. However, due to the high payout ratio, the only way for REITs to grow profits meaningfully and organically is by employing a lot of leverage. And I think taking all of this into consideration and considering that as of March 2023, publicly traded US equity REITs posted one-year average dividend yields of just 3.5%, which is actually below the 10-year US Treasury yield, I'm going to put REITs in the B tier. I mean, I think you could make a case for putting REITs into the A tier too. It's a tough choice, so let me know where you would have put this asset class in the comments down below. Okay, and this brings us to stocks, which historically are by far the best performing long-term asset class, as shown by this graph from the book Stocks for the Long Run. But the outperformance of stocks is also well documented by a lot of other studies. And so obviously stocks as a group have to go into the S tier. However, not all stocks are created equal, and I want to discuss a couple of stock categories that I want to distinguish between here. So let's start with ETFs. Again, not all ETFs and indices are created equal, as I highlighted in this video right here, but a broad market and low cost index, or ETF, is a great choice for everyone that doesn't want to spend hours analyzing stocks, business models, management teams, and so on and so forth. So without doubt, broad, low-cost ETFs belong into the S tier category. But as I said, not all stocks are created equal. If you want to invest actively yourself, because it offers you the chance to outperform the market, you absolutely need to know what you're doing and which stocks to invest in. For example, stocks that are trading at a price that far exceeds their intrinsic value are going to perform terribly, very poorly. I think one of many examples of this is Microsoft, which has pretty much always been an above average business, earning high returns on capital. But if you bought Microsoft stock in 2000, for example, would have been a poorly performing investment because the price you paid relative to the intrinsic value of Microsoft was way too high. On the flip side, if you bought Microsoft around 2010, when it traded well below 10 times its free cash flow, I think you have done spectacularly well. So price matters, and hence stocks trading at very high valuations definitely deserve a spot in the D tier. You have to know how to value stocks, otherwise you are basically destined to fail. Now similarly, companies that carry way too much debt, they can be extremely risky too. Too much debt or leverage can be lethal to companies, as they may be unable to make their payments when the business itself hits a rough patch or the overall macro environment becomes very challenging. At the same time, we have to point out that leverage in the right hands can be used to boost returns, but generally speaking, I would say try to avoid over-leveraged stocks, and that's why I've put them in the C tier. Then another category consists of stocks that are simply running a business model that is very hard to understand and that you simply cannot understand. This may, for example, be pharmaceutical companies, medical companies, maybe certain banks or financial institutions, maybe businesses that are operating in another country, like China, for example. And I would say, as a general rule of thumb, simply don't touch these stocks. If you cannot understand how the business makes money, the stock is not meant to be owned by you. Clearly, I will put these businesses that are too hard to understand in the D tier. So we've already discussed ETFs as an investment vehicle for stocks for those interested in participating in the long-term upward trend of stock markets all around the world, but do not want to spend much time actively analyzing businesses. Passive stock investing can also be achieved through mutual funds, which is basically a fund run by another person, a fund manager that picks stocks for you. However, it is very well documented that in aggregate, active equity mutual funds underperform broad stock market indices. That's mainly due to high fees, over-diversification by the fund managers, and flawed incentive structures. I would recommend you read this article here by Value Walk to learn more about this phenomenon. And you may also want to take a look at this thread here that I recently published on Twitter. There are undeniably fund managers who do outperform the market after fees. For example, I just came across a microcap manager who has compounded investors' capital at a rate of 48% annually over, I think, the last 6 to 7 years. But finding these managers is very difficult, and it's also fairly difficult to get access to their funds. So where do I put mutual funds? Well, I was struggling whether I should put them in the A or B tier, because after fees, many funds actually still do relatively well, at least compared to some of the other asset classes that we have discussed in the video. But I guess I have to put them in the B tier here. Okay, we've got 2 more categories. First, I put high dividend yield stocks in the B tier too. I think high dividend yield stocks seem very attractive at first due to their high dividend yield, but what investors should really focus on is total shareholder return. And on average, high dividend yield stocks are often very mature companies that do not have much room to grow anymore and often underperform the broader stock market. Which brings us to the holy grail of investing, so-called compounder stocks. These stocks usually operate in industries with very high returns on capital. The businesses themselves earn very high returns on capital with lots of reinvestment opportunities. They have great management teams, a very strong competitive advantage. And if you can buy these stocks at a fair price, this asset class, compounder stocks, definitely belong into the S tier as well. All right, I hope you learned something in today's video. Thank you very much for watching. Take care.